Like, subscribe, and share to Voices of Linden TV.
Welcome to the Money Minute with Michelle Moseley. Today, we're so happy to have again with us Carol Smith. Carol, how are you today?
I'm doing good, Michelle. Thank you so much for having me again.
I notice you have some beautiful spring-like flowers behind you. What's the story there?
Those are my Mother's Day flowers from my kids. They showed up at my front door, heard the doorbell ring, opened the door, and they were sitting on the step, and they're beautiful. I was so happy to have them. I think my kids love me.
That's awesome. Carol, we just want to, as you know, we're going to discuss how to manage our finances. We want to continue our discussion as we started before, looking into, managing your finances for your financial well-being. So in money management, what are the basics? Those are some of the things we want to look at. What are the basic investing principles? Can you just discuss that a bit with us today?
Okay. So, excuse me looking down. I'm just checking my notes to make sure I don't get them in the wrong order. But anyways, so the basics of investing then, for example, the principles of investing would involve you looking at your time horizon. So everybody has a time in which, for example, someone might say, I want to retire when I'm 50. I want to retire when I'm 65. You have a time that you want to do something in. And what you have to do is you make a plan based on this time. Now, by working with a financial professional, you can have these numbers entered into a program, for example, and come up with whether this is a realistic expectation. So a person that says they want to retire when they're 50 may actually, when the numbers are done, it may come back showing that you need to work 10 more years in order for you to enjoy the type of retirement that you want to have. So it's very important when you're putting together a retirement plan that we look at your goals. We look at the objectives that you have for the money, and then we look at your time horizon. And at the same time, we also have to look at your risk profile. So that means the amount of risk that you're prepared to take in order for you to achieve the financial goals you have, in order for you to earn returns on investments, because lower risk investments obviously are going to give you a lower return, and higher risk investments will be a higher return. And the reason why the time horizon is really important is because people that are invested for their retirement, for example, there is going to be ups and downs and fluctuations in the market. And the closer you are to your time horizon, the less tolerance you have for what I call the wave, that you have to ride the wave. And people that are closer to retirement don't have that much time to ride the wave. But a young person, for example, will be able to be in much more riskier investments because they have a huge time horizon, probably 20, 30 years, where they're able to weather the fluctuations of the market and achieve their goals and enjoy really nice returns. A person who is close to retirement, maybe someone who's in their 50s, late 50s, that person doesn't need to be experiencing too much risk for a long period of time, because they're at the stage where they want to preserve what they work for their whole life. So they don't want to ride the wave too much, but they still want to get a decent return. So learning what is your time horizon, what is your risk profile, and what are the objectives for your investment are really important for you to be able to achieve your goals in investing. And it's also important for you to have a plan, because I don't know what your thoughts are, Michelle, but sometimes we have people that do sporadic investing, especially now during this pandemic. There's a lot of people that are investing in all kinds of different investments. Have you had that experience?
Yes, I have. And, while there's a place for spur of the moment kind of investing, I would not deny that. What you have to be careful, like you just alluded to, Carol, is that you do need a plan of action. So I found that a lot of people are going after the Bitcoin, that's the new flavor, and going after a lot of stocks without putting in any kind of research into what that stock is, what the fundamentals are they really suitable for that particular type of investing. So yes, there is something to be said for spur of the moment invested. You're looking at one right now. I've done it myself. And the bottom line is you've started. And if you've started, it means that potentially, just like you mentioned, Carol, that investment may actually end up going to a financial advisor like yourself to look at. down the road, because it's not as easy as one would think it would be. So there is something to be said for spur of the moment. It gets you started, but then you also have to be careful and make sure that you are, getting the help of an expert like Carol, for example. Carol, I just wanted to quickly ask you with regards to, having an understanding of the methods that are involved in calculating investment returns, just for, in layman terms, so that we could all understand that.
So basically, depending on a person's risk tolerance, they can invest in various investment vehicles. For example, a person has a very low risk tolerance might decide to invest in GICs or term deposits where there's a fixed return, but because there's a very low risk to this type of investment, the return is also matching that. It's also very low too. Then you could be invested in stocks, you could be invested in mutual funds, which is also investing in stocks, but investing in mutual funds is like owning units of stocks. So in other words, you go to a financial advisor, that advisor puts you into a portfolio, that portfolio holds many different stocks, and then you own a unit of that stock, portfolio, and that's how you invest in mutual funds. It's just very important to make sure that if you are going to invest, whatever it is you choose, that you don't get caught up in FOMO, fear of missing out, where, as you were speaking before, Michelle, where as you said, you get started. So it's good that you actually started doing something. But when there isn't that sort of direction then that's guiding the reason why you're investing, then you could be jumping from one stock, one crypto or whatever to another thing. And like you said, all of these are they're valid types of investments, but it's important for you to understand where you're at, what your unique situation is, what your time horizon is, and also the type of return that you need for you to achieve your goals. And one of the tools that's used in the financial services world is the rule of 72. And basically in the rule of 72, you would use this to figure out how long does it take for me to double my money. And so, for example, I actually wrote down a couple of examples here. So example, if you had a return of 4%, it would take you approximately 18 years to double your money, 6%, 12 years, and 9%, 8 years. So the rule of 72 is basically you are dividing the interest rate that you believe you're going to get from your investment into 72. And then this is how you get to see, it's a very good estimate of how long it would take for you to double your money, but very important for you to not just invest money, like hear 'em, scare 'em, just invest money without any type of thought, but to actually have a goal, know your time horizon, your risk tolerance and so forth, and make sure that the investment that you're in is going to help you to achieve that goal.
So are you telling me that jumping into something like Bitcoin, it's not supposed to happen? I mean, if I can make a whole lot of money off of Bitcoin, why am I? Even for your rule of 72, Carol, I mean, that is giving me the vibes that if I have an investment that is giving me significant return, then those years that you are putting forward, it is not going to be applicable to myself. I could potentially get that money within 2 years or so.
Well, I mean, with cryptocurrency, I mean, it could be within a few days, depending on what you're investing, I'm sure. However, with great return is great risk. Okay, so crypto, it's not that like I'm not licensed to speak about crypto, but crypto is something that my clients ask me about all the time. And this is something that you just need to be educated. You have to do your research. So if you decide that this is something you want to get into because everyone and their uncle is investing in crypto and they're making money and they're becoming millionaires and so forth, there's nothing wrong with you looking into this. But you also have to remember that it may not be in your best interest to put 100% of your net worth, all your cash flow into cryptocurrency. Maybe you need to put 10%, maybe it's 20%, because your net worth, it's basically everything you own. You don't want to put all of your eggs into one basket. You want to make sure that you're diversified, right? So I know that the younger generation really do pay attention a lot to cryptocurrency. My own son as well. He loves to do the research and the technical analysis and everything. But for the average investor that wants to achieve their retirement goals, which is usually the first goal, or It may be that you're saving for your child's education and you want to make sure that there's money for your child to go to university. Sometimes it's better to work with a financial advisor who will invest the money for you using tools like mutual funds that will give you a return of 9% or whatever it is. But we're not talking about returns here, but will give you a decent return that's going to help you to double that money to be able to pay for that education, to buy that house, or just to save for that retirement income that you're looking for. So sometimes doing it by yourself, what happens is we as investors, we have a tendency to become emotionally affected when the market dips. So when the markets dip, instead of buying the dip, which is when everything's on sale, we lose it. And then we want to sell everything and we lose our minds. And what happens is advisors like myself, when people are opening up stock accounts during this time, during the pandemic, and they're investing in crypto, but especially the people that are opening stock accounts, they're excited, they put some money into a penny stock or whatever, it made them money. But then all of a sudden life happens and they're really busy. And then the account is tanking. They don't have time to look at it. Ultimately, what happens is it gets transferred to someone like myself, who has to now invest this for the client in something that is much less hands-on. And so it's very important that whatever decision it is you do, you don't get caught up into FOMO, into the fear of missing out, and also investing in get-rich schemes by trying to buy into that hunger that's out there, because ultimately you can end up losing a lot of money.
So what I'm hearing you saying is that the spur of the moment, though it may have some, place in this whole investing market, is that it's better to have a plan of action, and that plan of action should be guided by a professional. I'm inclined to agree with you there. A lot of times, over time in the industry, I try to explain to people that with your investment and the reward from your investment comes risk. So a lot of people are right now jumping into stocks. You're quite correct. And at this point, what could happen is that they're probably doing very well, but if the market goes belly up and then they cannot manage it, then what happens, that portfolio that was looking really spicy just begins to tank. Carol, so on that note, I just wanted to ask you very quickly, I know that we touched on this very briefly before last month, but I wanted to touch very quickly on possibly a budgeting roadmap, because it follows that if you are going to follow a plan, you have to know where you are in order to follow that plan. Would you not say?
Yes, you do. And I think what's really important is if you are trying to achieve a goal, whatever it is that you have towards your financial future that's in your mind that you want to achieve, you have to plan for it. And the best way to plan for it, besides having a financial plan, is budgeting. And the most effective budgeting is the zero budget, where you allocate every dollar that comes into your hands to something, savings, expenses, a living cost, but every dollar is allocated. So at the end of the month, you tally up at zero because you've paid yourself. And that's how you end up accumulating that wealth that you want and making sure that you take care of everything that's outstanding, but you've also done the most important thing, which is paid yourself. And
so you're saying that going back to just briefly to what you were talking with regard to calculating those returns, you're saying as you pay yourself, it's not a good idea to just kind of tuck that money under your mattress, is it? Because that will obviously not get you anywhere. What's the reason behind that? I know that, a lot of people, even for GICs, when I used to be an advisor within the branch, a lot of people would invest in GICs, and I try to get them to understand why the GICs were not necessarily the good thing for them, especially in a low interest rate environment. Could you just expand on that, Carol?
Well, first of all, I'd say that if a person is a GIC investor, and that's what they want, let them be a GIC investor. Because as an advisor working with someone who is a GIC investor, I don't want to stress them out or stress myself out when I try to encourage them to stick their neck out a bit and get a little bit more risk if that's their mentality. But the reason why investing in a GIC is not going to necessarily help you to achieve your goals in the long run, especially when you have a time horizon of 10 years, 15 years, 20 years, is because when we look at inflation, if inflation is around 2% and you're getting around the same or less in a GIC, then you are not outpacing inflation. It's actually eroding your money. It's eroding your cash value. And so therefore, when you think about 20 years ago, how much did it cost for a bag of milk? And how much does it cost for a bag of what $1.99 could buy a bag of milk maybe 20 years ago? But you go to the store with $1.99 today, and that can't buy a bag of milk. So we know that inflation erodes the purchasing power of our money. So that's why it's really important to have our money invested. And ultimately, we know that when you're invested, there will be fluctuations. But unless you move your money, you have not materialized a loss yet. It's when we become emotional and the market dips, and they do happen. They happen, and we don't know what the cycle is, and nobody can time the market. But market dips do happen. And as long as we don't sort of, like I say, like lose our minds when the markets are down, but we stay in because we're invested for the long term, then ultimately we will usually achieve our goals as long as we stay invested and don't materialize the loss by selling when the market's down.
I agree with you on every single point, Carol, with the exception of the GIC. If there's a GIC investor, I don't advocate for them to remain a GIC investor. And I'll tell you the reason why. A lot of times I used to say to clients, for the exact reason that you gave, where you said inflation could erode their return. So essentially, they're making nothing. They're not getting anything when they're invested. And that's one of the things that I used to tell people all the time. If you're going to have your money in something that is safe and you consider it, okay, it's safe, it really is not safe. Because if you cannot buy, you do not have the same purchasing power today, like you had last week or last month or last year, then you really are not in a safe investment. Actually, you're in an interest rate risk investment, and that inflation, rate investment, and that is really not to your benefit. So I'm going to challenge you and say, no, I'd hope that if you're confronted with an investor who is primarily a GIC investor, that it would be a good option to say to them, you know what, I know that you like that, but perhaps you want to take a look perhaps more at a bond mutual fund or something to that extent.
My true opinion of the GIC investing is that investing in a GIC is the same as putting the money under your mattress. That's what my true opinion is. But if I meet somebody, and like I said, and they do not have the tolerance, the profile, they cannot cope with the risk, then for my sake and for their sake, I'll put them in a GIC, because it's because you cannot basically force a person against their will, right? So if they can't see it, then you give the client what the client wants.
But you do tell them about that, the inflation risk. And perhaps a good thing is to tell them as well, let's put part of your money here and part of what I'm suggesting. And I can tell you, because I've done that strategy very well. And then they begin to see that little bond fund that is fairly conservative doing much better than the GIC. And all of a sudden, okay, we're going to take some more out of the GIC. And little by little, they begin to put it into a conservative investment. I just want to say thank you very much for today, Carol. Short segment. I really appreciate your coming out and having this conversation with us. For everyone out there who is watching this, you may be watching it, you just may have come across it. I hope you can find a bit of a nugget that you can take away. If you have a question, you don't want to ask it, in our link at the bottom, you can simply send us an email, and it's moneyminutemm@gmail.com, and we'll be more than happy to answer that question. Over time, we plan to have a few other experts in addition to the lovely Carol Smith back with us again, and we are hoping to be able to answer your questions and give you some important takeaway. Thank you very much for joining us today.